down the hammer and pick up the pencil. You're about to listen to the Savvy Radio Show. Learn from real-life real estate investors, experience revealed with the Savvy Landlord as your host.
Hey, you tuned in to the Savvy Radio Show. Man, I'm excited that you tuned in, right? Because there's so many podcasts. I was talking to someone the other day. They just listened to like several, like, I don't know if he said 50. And people ask me all the time, do you listen to podcasts? I literally do not have time. So I know if you tuned into this, it means a lot to me, and you're important to yourself, that you're learning something new, something that has drawn you to this podcast. I'm excited. What I do is I listen and read books during at least an hour to 2 hours a day. That's what I do. That's how I stay informed. I would listen to podcasts, but when I turn into these podcasts, they're just a bunch of jibber jabber talking about this or how cool they are, and it drives me bananas. Like, I don't want to say any specific ones, but when podcasts first came out, that's what it seemed to me. And I'm a little bit older, so I don't know if I missed the boat. I know there's a lot of good podcasts out there, and I'm glad that you found them. I'm ultimately thankful that you found the Savvy Podcast. If you can let me know any subjects that you want me to cover, or we're going to grow. But today we're going to talk about real basic. We're going to talk about a creative way to acquire assets, aka property that brings in money into your world. And so I realize that this subject, aka SubjectTo, to existing mortgage, is a common popular thing right now for some odd reason. Several years ago, maybe 6 to 10 years ago, SubjectTo was raging all over the country maybe it was 10 years ago, when mortgages were defaulting like crazy. The world ended, and the way to save people is through a SubjectTo. And so I'm just going to read this from a page out of Carlton Sheets. And so if you don't know Carlton Sheets, he's like the first original 1983 guru. And all the old school people, probably anyone that's 40 and over, has purchased a Carlton Sheets course. I mean, it's so crazy because it's so powerful. And I definitely recommend you support what he has paved the way for. I wouldn't be where I am today. Yes, I saw an info commercial and I bought the course, and I really basically never went through it. If you want to really listen to it, go back, search into my podcast to Brian Nix. That's what his turning point to make him a multimillionaire was through Carlton Sheets. You know, my road has been through Rich Dad Poor Dad. Pretty much everyone has read that book that's in this space, which is interesting. But outside of our world of real estate investing, no one's ever heard of Kiyosaki. It blows my mind that 34 million copies of that book were sold, and only 1,000 copies of The Savvy Landlord. So I know that I'm a nobody out there, but it doesn't really matter. I'm a somebody to somebody else. And you, husband or wife, you're somebody to somebody else. And you need to take this real estate or investing seriously, and you need to add this creative tool to your tool belt. So this will come up in your world. Okay. Now, I'm not an expert in SubjectTos. I have done several of them. They have not gone as beautifully as they want to. I know that I will be doing a walkthrough Wednesday pretty soon on this subject and kind of go through the nuts and bolts of it. But it is a great tool. And just a heads up, with anything that you want to be successful, it takes time. And I just figured out that I have to listen to or study something more than once to really gain it. And if you study the cone of learning, you're going to have to simulate it, practice it, and go over it. And I was just actually studying, or actually writing out my podcast for the SubjectTo that I'm going to release next week. But you just keep that in mind. I might say some things that make sense, or it's going to be completely left field to you. An average person that has a traditional mortgage, which is 90% of the world, or I would say 95%, they're not going to understand this technique. And they're going to have a lot of objections, and they're going to have a lot of doubt and fear. But what happens is that their desperation of losing their home or losing their credit, they're willing to listen. So we should just have a party. We should just have a subject to event at the office. Just grab some food and just hang out. Maybe even play poker or something. If that's something, we need a social event in society. Maybe there's someone in your market that has a creative. I know there's a guy in my market that name just popped up in my mind. There's a name that popped up in your mind. Maybe you should just get together and really on a Saturday morning and just say, hey, from 8 to 9 or 7 to 8, we're just going to practice the SubjectTo, and I definitely recommend it. So, but for all that to say, what the freak is a SubjectTo? So I'm going to break it down to you. SubjectTo is a way of purchasing real estate where the real estate investor takes title of the property, but the existing mortgage, aka loan, stays in the name of the seller or the originator, the person that got the loan. In other words, a SubjectTo is the existing finance that's already there. The investor, you, me, now controls the property and makes the payments in the seller's name. So basically, you're taking over the property, and I'll kind of go over that here in a minute, and you are making the payments on their behalf. So you can acquire this property with little cash or none. SubjectTo is a creative way, it's a technique that you can acquire asset for little or no money at all. So I'm reading it now here, and I'll break it down here in a minute. So but this real quick, if you want to kind of wrap your mind around it. So what happens is, why does this happen? Someone may be married and they're getting a divorce, or someone needs to move to the other part of the country and they bought their house wrong, or there's not enough equity, or they don't have cash to fix it up. There may be a ton of equity. And I'm just going to keep these numbers simple. It could be $100,000 house that they only owe $60,000, but it needs $20,000 worth of deferred maintenance. The guy's lived in it for 20 years. He's been paying down on it and just doesn't have the money to get it up to retail ready. Or, it's still kind of on the edge of to selling it to a real estate investor. And so it's skinny. These are rare, but they're possible. Have I taken them down? Yes. SubjectTo the easiest, fastest, and cheapest, and it's not that complicated to acquire property. Typically, the homeowner who are behind on their payments are already close to foreclosure, or they may be in foreclosure. They're the ideal candidate for you to do a SubjectTo. Sometimes you may have to step in and get them whole. Meaning, you got to analyze this deal. What is the real ARV? Because you are becoming the owner of the property on paper. You can approach the homeowner and explain to them, what you're trying to do, what is SubjectTo, and that the financing is going to stay in place, and that this is a win-win scenario for you and them. Now, there's a lot of things that is positive with this. One, you're helping this person to avoid foreclosure, which could really mark their credit. Basically, you're here to help them, save them from disaster, that they won't be able to buy a property later on because they may have a bankruptcy, and if they don't make their payments. So that's kind of like your sales presentation. Hey, let's create this a win-win. Now, what happens is so people are so emotional, and it's just such a depressed situation that they will just sign off on it. And so, but 3 or 4 years later, you may have gotten a tenant in there, or you got a lease purchase person in there, and then they're trying later down the line. The seller wants to purchase another property, and they cannot purchase another property. Maybe they can, but usually they can't because they don't have enough funds or income to debt ratio, that they are blocked from buying another mortgage because they have getting another mortgage because they have an existing mortgage in place. And so their income to debt ratio there won't suffice. And so that may circle back later. And so when I do SubjectTos, I'm always prepared that I would not do a deal that I would not try to refinance later or sell off, or there's some margins. And I do have some SubjectTos that are way too skinny. The only way that they're going to play out is over time. And I'm completely transparent with the seller that we are in this together to the end. I let them know that I'm going to try to sell and market the property so to get it out of their name. I'm also going to let them know that I'm going to put money into the property and I'm going to maybe possibility rent it out. And so you just got to have an understanding of what's happening in the process. Now, there is some risks. One of the main risks is, well, there's two in my mind. One is that they could file bankruptcy. Now, I've had a SubjectTo file bankruptcy. And during that bankruptcy, the bankruptcy attorney didn't see the need to attach the real estate investment that I took down. So in this case, it was a real estate investor. They had $700,000 worth of property. They owed $500,000. They were going through bankruptcy. I actually acquired the $500,000, which is I just instantly made $200,000 worth of equity. Did not pass through bankruptcy. They actually got their bankruptcy finalized without that being an issue. Fascinating. And I don't know how that as attorney took care of that, but at that time, it wasn't a big deal. Now, sometimes some other people think that this is like the holy grail or all this works all the time. Now, here's another caveat that you need to be aware of is that insurance is an issue because technically that the property still in their name, not technically, and I'll figure that out in a second, but their loan is in their name. And so they have original insurance that names them as the insurer, and their mortgage person is insured as well. So if you ever have a claim, you know this, that the insurance company may write a check, and sometimes it's usually written out to two people. One, the mortgage, the bank, and two, the person that owns the insurance policy. And so they both have to agree to get a release of the funds. And so that becomes sticky, and maybe that's another episode, but you understand now, it gets real complicated when you, the investor, has taken this home over. There's some exposure there. If you get insurance, obviously when you write insurance, you're going to have your name on there, but then it's not going to have the seller's name on there, but it may have the mortgage person's name on there because they require insurance because they have a mortgage on it. And so if they see your name on it and it doesn't match up with the original purchaser, that could be a flag for an acceleration clause. And so let me read what the acceleration clause is. And which that is because of Garner State Germain Act, placing property into a trust is permissible, but does not violate the due on sale clause. The due on sale clause is widely thought of not being a threat to the investor because the mortgage companies are not active calling notes or violating this clause in a mortgage. Some mortgage companies, however, can consider this practice fraudulent in a certain degree. So what that means is that back in the 80s, the St. Germain Act came out and people were just assigning their mortgages to whoever and whenever. And if you Google up the Penn Bank scandal in Oklahoma City, actually, Penn Square Bank scandal, where back in maybe it was the 50s, I'm not really sure, 70s, somewhere around there, 70s, that people were just assigning mortgages and banks were kind of basically screwed. They would sign it to some ding dong and some ding dong would just take the loan over and then stop paying, and the bank would not be able to, they could foreclose, but they could not go after someone. There was nobody liable. So this act, the Germain Act, was instituted to protect the banks. Well, it's in everyone's mortgage that if you change the title of the property, it could accelerate the clause. Now, here's the deal. That necessarily does not happen all the time because you can deed it into a trust. And when you deed the property into a trust, it's protected out of this St. Germain Act. So, and I could be wrong what I'm saying, but the point is that this is how it rolls down basically. Number one, you got to learn this stuff forward and backwards because you're dealing with people's lives. You're dealing with integrity. And so you've got to let people know exactly the worst, the best, and all that could happen. So in a nutshell, you connect with this seller. You say, this is the only option that you have is that I can take it subject to existing mortgage. And they're like, what's that? Well, what I do is we create a trust and I can do the paperwork for you. I create the trust. I deed the property into the trust. Now, technically, in the city or in the state or whatever owns the legality of the property. They are the titled person or entity of this property. Now it's in a trust. Okay. It's kind of like a sheet that no one could see what's behind closed doors. Then you, the investor, becomes the administrator of the trust. Basically, you control the trust. Now, the beneficial area of this trust is still in their name, but you are in control. So you could sell the property for a profit. You basically control the asset. And so SubjectTo is a great way to build a portfolio for income producing property. There's no limits. And so they're not pulling your credit. You're not qualifying. It's extremely powerful, but there's some techniques in the way you need to present it, and you need to have your systems in place, and you've got to understand the pitfalls that could happen. One, they could go into bankruptcy, so you got to make sure that they're pretty legitimate people, and you're going to have some finagling with insurance. And so there's some questions that you may have. You definitely email me or call me or leave me a message. Go to savvypodcast.com. Click on the link or text. There's a number on there. You can text me. It goes right to me, and I can get those questions answered. I know this was a little rough. I didn't organize this. I just threw this together before I started doing the walkthrough. So next week, what I'll do is I'll go play by play exactly how I did a SubjectTo, and maybe shed some more light into it. So I think SubjectTo is a wonderful tool for creative financing, creative deals. It's a tool that I think you should spend some time learning and memorizing. It's a memorizing tool. There is some pitfalls. There could be some heartache with it. The cool thing is, here's another thing. You can get a house under SubjectTo. A wholesaler sold me one. Yep, he sold me one for $1,000. I took it SubjectTo, and it became a disaster in my mind, where I plugged in another several thousands of dollars to the tune of about 5 G's, putting in a sewer line or what. I can't remember what I did exactly. And then I realized it's going to take me 5 years, maybe even longer, to get my ROI back. So what I did is I passed it on to another investor. And so they have no money in the game, and it's going to pan out for them. So, and it was such an easy transaction. I just controlled the trust. I've made a 1-page document that this new investor, blank LLC, is in control of the trust now. So the original sellers that sold me the property, they have no idea what happened, but I just deeded the property, not really deeded it, but I gave the trust over to someone else, notarized it, and now they're in control of that asset. So your goal as a real estate investor is what? To control assets. Your goal is to cash flow. If that's SubjectTo cash flows, take it. Now there's some SubjectTos that some young investors have brought to me that they want to take down, and the numbers just don't work. And what happens is a lot of people will get behind on their mortgage payment to the tune of 6 months, and so you got to pay $10,000 to get them whole, and then they didn't do any deferred maintenance, and then they need another 10 or 20, and they're trying to sell you a house for $130 that's worth $130. Well, it's not worth $130 when you put $20,000 in deferred maintenance, like a hole in the ceiling, and $20 and the AC doesn't work, and then they're behind $10,000 in bill. You can't help them. Then the next phase would be foreclosure or a short sale. Anyway, this is your friend Steve VanCauwenbergh. I know I was all over the place. I probably said some things wrong. I definitely recommend that you trust me, yes, but verify what I'm saying. Again, I'm not an attorney. I'm not certified by the bar of Oklahoma how to do trusts, but you can figure all this out. This would be a great conversation starter. This will definitely be elevate your skill set as a real estate investor, and that you're able, here's the deal, that you're able to help people through a financial problem. I mean, I've had a lady call me that her husband walked out on her, left her in a financial disaster. She did not, they were overextended. They needed 2 incomes to provide for this $150,000 house. I tinker, and I was able to walk her through the process on, how to get out from under this. And so sometimes it does work. It saved her because the husband disappeared and he didn't care about his credit. She did because she's by herself. She's going to need to live somewhere. And when people get a foreclosure on their credit or a default, it's even hard for them to rent an apartment. And so apartments for sure pull credit and see if you have a foreclosure on there. They know if you can't pay a foreclosure, you can't pay your rent. Now, mom and pop landlords, they kind of see, they don't pull credit, and they may understand your sob story, but her opportunity to rent an apartment or to get back on her feet is very slim. And I was able to walk her through a SubjectTo and understand the process. So it is a great tool to help somebody in a bad position, and they're all unique. None of them are the same, man. I'm telling you, it's almost like, banking in my mind, not every loan officer is the same. So their documents may be the same, but they're not the same. Hopefully this helps you. Hopefully this sheds some light in an area that you didn't know of. If there's a subject you want me to cover, let me know. I would appreciate it. But through this process, you should be buying assets.
What is the Savvy Bootcamp? Are you struggling to get to the next level as a business owner, as an investor? Do you want to multiply your income? Sign up for the Savvy Bootcamp, a strategic and supercharged one-night and one-day event designed to shortcut your learning process and propel you forward. Just value, no upsells, and an intimate setting to build relationships with like-minded investors. We will be covering how personality profiling can make you a millionaire, outsourcing and the nitty-gritty of maximizing your property management, scaling your business through systems and automation, technology hacks you should be using every day, and how to raise private money. Go to www.savvybootcamp.com now to register or to find out more.
Thanks for listening to the Savvy Radio Show. Glide online and listen to our other motivating episodes at savvyradioshow.com. Connect on Twitter at LandlordBook and always be buying assets.